Hello, investors. Thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about an exciting company, Elastic. You might not have heard of it, but it's a good company. I hope that you'll find it enjoyable, this video. So, Elastic is a search company, right? You obviously will think of search as being like Alphabet or Google or whatever, but it's a search company in that it allows you to kind of get insights from the data that you use. It's a kind of similar a little bit to MongoDB. I'm not sure if you know that company, but it's kind of like that. So it allows you to kind of go through into a range of different apps to perform some analysis and visualizations. So it's about being able to get the data, deconstruct it, and look for actionable insights from that data. Okay, the business is clearly growing as we're going to go through. And analysts expecting the company to grow approximately 25% compounded annual growth rates. I make the case that it's actually likely to grow closer to 30% compounded annual growth rates. And that without any heroics, the stock is meaningfully cheap right now. So I'm going to just jump right in. This is a graph that you've seen me report in the last several weeks countless times. Okay, so this is elastic, and it was kind of going and going in the last several weeks. Poof, you can see the stock was just hit really hard. And the reason for that is simple, investors want absolutely nothing to do with yet another unprofitable cloud company. I mentioned cloud because kind of this is part of the story that I'm going to go for. So here's the thing, right? Right now, investors are just looking to themselves, okay, and thinking to themselves, this is the guidance for the company. You can see here, particularly important is Q4. Sorry, I'll just remove that a little bit. Q4 2022. So the guidance points to approximately 26% at the high end. Okay, so for a company that was growing in Q1 2022. Remember, so the fiscal year and the calendar year misaligned. So I'm talking just about the fiscal year. So for fiscal to Q1 2022, which is a few quarters ago, they were growing at 50% compounded annual growth rates, and the guidance for Q4 is pointing to approximately 26%. It points to a meaningful deceleration, right? We're talking about 2,500 basis points. This, for a company that's supposed to be growing rapidly, with all the buzzwords attached, it doesn't seem to be the case, right? So the guidance is really kind of like not that enticing. And this is what I want to highlight, okay? So I'm going through now in the screen the past more than 10 quarters. And you can see for the past more than 10 quarters, management has consistently guided for lower revenue growth rates, and they've actually beaten their guidance by close to 5% every single time. So I'm not going to say that, that the company is clearly growing at closer to 40%, particularly for the next quarter. But I'm talking about a company that's going to be growing at close to 30%. This is how it truly looks like right now. And this is how analysts following the company pricing in the company. The analysts following the company are pricing in the company to grow at approximately 25%. All you can see, it is the next several quarters, well into fiscal 23, which is our calendar 2022. So the company is growing at closer to 30%. Now, I wanted to break down some more things here, right? So the thing that interests me meaningfully about Elastic is that it's led by the founder. The founder has 9% worth of equity in the company. This translates to $1 billion worth of stock. Okay, so it's somebody that's clearly very much motivated to drive the share price high. Okay, so Elastic has three solutions really. There's a search company, which is really what it's about at its core. It has some kind of side products, which is observability, and this is ability to track and monitor how how websites perform. And then the newer thing, which is the security side of, which is about threat detection. So it has the one core product and it's adding new products to it, and that's why its net retention rate is very, very close to 130%. Remember, net retention rate is the company ability to give you more products and services over the next 12 months to the cohort that just got enlisted right now. And if you're able to kind of get some customers on board and then you upsell them over the course of the year by 30%, that's, gives you everything that you need, it gives you pricing power. It's really very, very attractive business model. And this is what I want to highlight, okay? This is the subscription side of the equation. So 92 more or less percent of the revenues are subscription based. There is some professional services which are not included in this graph. So this is just the subscription side of the business. And you can see cloud already makes up 36% of the business, and that's growing at 84% year over year. Now think about this for a second. management is saying that over the next 3 years, that cloud will be make more than 50% of total revenues. They're clearly going to beat that. I mean, it's clearly if you have one side of the business is 36% and growing at 84%. I mean, that means that the rest of the business, the subscription side of the business, the on-premise and the licensing side of the business is contracting or not growing quite as fast. So all in all, I think that they're going to easily beat that estimate. Now, here's something else that I wanted to highlight, okay? So the billings is a forward recognition of the revenue that's going to come in. So I'll just repeat that. So you want to see billings higher typically than revenue growth rates, and that gives you visibility that they're going to be able to book that revenue in over time. Now, in the case of Elastic, billings are slightly lower than the revenue growth rate. The billings for last quarter were 29%. Now, if you think about it, right, they talk about it on the call. The monthly cloud business doesn't have any billings attached because it's consumption based. So whatever happens in that quarter gets recognized in revenues in that quarter. And a lot of new customers come up and they get on board with the monthly subscription business, and later on over time they kind of increase their spend and they go on to an annual, and the annual does get reflected in the billings, but close to 15% of the subscription business is cloud is a monthly subscription business. So 15% of the revenue stream isn't being recognized in that quarter. So if you think about it, when you look at the billings, you are going to see that the billings are going to be not high enough relative to where the business is going over time. And that's why the stock is substantially sold off. Now, if you go forward to next quarter, you're going to see what happened in terms of the monthly revenues that were recognized this quarter increase next quarter. So I suspect that when people come around to think about this business model, they'll start to see a business that's going to be growing much closer to 30% compounded annual growth rates relative to what they're seeing right now. The other thing that I wanted to highlight, which is, and this is really the core of why the stock sold off. So you can see here, the business had been growing its operating margins. So for fiscal 19, it was negative 21%, and it had been going higher to fiscal 21, which was last year, at negative 1%. And the guidance for this year, it started off at negative 3%, and now it's kind of getting closer to, after they upped their guidance, to negative 2%. That being said, you're still left with, quote unquote, yet another cloud business that is unprofitable. So with that in mind, it's clear why the stock sold off so substantially, because everything else in the cloud in clouds are getting sold off. So with that in mind, why would investors even be that compelled to get involved here? And I get that, right? Now here's the thing, right? The stock is, let's make the assumption that if they grow relative to their fiscal guidance for 2022 by 30% into fiscal 23, that reaches 1.2 billion in revenues. That puts the stock priced at 9 times forward sales. Now, if you think about it, right, let's compare over with MongoDB that just announced a few days ago. So MongoDB, their guidance puts the stock trading at 31 times forward sales. Now, I know that MongoDB has huge fans. People are really fanatic about the product. I get that. Uh, but the business is still meaningfully unprofitable. So for next quarter, they're looking at operating margin to be at negative 5%. So in that comparison, Elastic is actually not that bad. And the only reason why MongoDB really dramatically saw their share price go high in the last several days is because when the guidance came in, people had been expecting it to be decelerating the revenue growth rates, and they came out to close to 50% revenue growth rates and just blew up everything. And it was during that period where many stocks were selling off. So in that frame of mind, it really upsold. But you're paying 31 times forward sales for MongoDB, and this is somewhat similar at 9 times forward sales. So in that comparison, I think that is quite interesting. A few things I wanted to highlight. So the big uncertainty here is if billings don't get an uptick. If billings don't get an uptick right now, if you look back to Q1 2022, which is like not last quarter, the quarter before, billings were only up 23%. So obviously, billings have a tendency sometimes to kind of be meaningfully lower than revenue growth rates, and obviously investors are kind of like, oh my god, this is like not good. I don't want to get involved in this. But I believe that that's already well and truly factored into the valuation right now. The other thing is over time, the likes of Datadog also compete in observability and monitoring space. And if Datadog takes market share away from Elastic, that's going to obviously impact their revenue growth rates, which will then obviously impact the multiple that people will be willing to pay for the stock, and the stock could sell off. So those are some of the investment risks that I find worthwhile noting. But I mean, so just to recap everything here, so I have no skin in the game. And I believe that there's a lot to like here. So you're paying 11 billion market cap for founder-led business that clearly is well disposed towards benefiting from the overall cloud opportunity. Um, I make the case that the business is likely to grow at 30% compounded over the next several quarters into over the next 12 months. And you're paying 9 times forward sales for a SaaS business, which is 92% subscription based. So all in all, if I look elsewhere, I think that this is a reasonably good opportunity. I mean, yeah, do what you will with it. So anyway, if you want to find out what kind of stocks I'm buying right now, don't forget to check out my marketplace for deep value returns. You can see what other people said. Look at the reviews, and yeah, thank you so much for listening. Bye.